I'm Debbie Matz, Chairman of the Board of the National Credit Union Administration. Welcome to the fourth and final segment in NCUA's series on the crisis in the corporate credit union system. I hope that the first three presentations have helped you gain a better understanding of the background of corporate credit unions, the evolution of the financial crisis that has afflicted the corporates, and the actions NCUA has taken to stabilize the system. As we issue this fourth and final segment, I'm pleased to say that we have implemented a decisive plan to strengthen the nation's credit union system. The plan we developed directly addresses the disposition of the legacy assets held by some of the largest corporate credit unions. This plan has been developed in close consultation with the U.S. Department of the Treasury and the Federal Reserve. It builds on the measures that NCUA put in place last year when we developed the Temporary Corporate Credit Union Stabilization Fund. Those measures will allow credit unions to pay for losses from the legacy assets over time rather than in one lump sum. Our comprehensive resolution plan involves isolating the legacy assets to prevent us from having to sell them at severely distressed prices, securitizing them and giving them a U.S. government guarantee, and selling them to investors on the open market. The proceeds that are raised by these sales will fund the legacy assets, a key component of the resolution process. This will help ensure that we resolve the situation at the lowest possible cost, consistent with sound public policy. NCUA has also put in place a rigorous new regulatory framework for corporate credit unions, ensuring that a stronger set of safeguards will prevent a crisis of this magnitude from ever occurring again. Throughout the corporate crisis, you have made your voices heard through many town hall events, credit union meetings, and comment letters to the NCUA board, and we have listened. I assure you that we will continue to foster an atmosphere of openness and transparency as we move through this process together. I encourage you to visit our website, ncua.gov, so you can see the timely and detailed information we have posted about every aspect of our plan. Ensuring the safety and soundness of the nation's overall credit union system has always been and remains NCUA's top priority. Let me assure you once again, NCUA's share guarantee remains in full effect for credit unions. For consumers, your money is protected by federal deposit insurance up to $250,000 per account. The 90 million consumers who entrust their savings to a credit union can be confident that federally insured credit unions remain a safe and sound place to keep your money. Thank you for taking the time to watch this presentation. We look forward to keeping in touch with you as our plan brings about a resolution of the problems of the corporate credit union system.
Welcome to the fourth installment in our series of presentations on the crisis in the corporate credit union system. The NCUA board recently announced a comprehensive strategy to fully resolve the solvency, liquidity, and reputation risks that have been affecting the system. Those risks are associated with the corporate credit unions that have been holding a substantial amount of distressed assets in their investment portfolios. If you have not already done so, please take the time to view the first three presentations in our series, which outline the history of the corporates, the evolution of the financial crisis, and the steps that NCUA has already taken to stabilize the corporate system. Those earlier presentations can be found at the Corporate Resolution link on the NCUA website, www.ncua.gov. We will continue to use this type of presentation in the future as we move toward the final resolution of the corporate credit union crisis. Let's now briefly recap the first three presentations to gain a better understanding of where we are today. In the first presentation, we provided historical background on corporate credit unions and their unique relationship to consumer credit unions. We also discussed the critical services corporates offer. Corporate credit unions provide three primary functions to consumer credit unions: payment systems processing and settlement, liquidity funding, and investment services. In the second presentation, we talked about the economic situation that led to the current crisis. We discussed the corporate's investments in private label mortgage-backed securities, how the economic downturn affected the value of those securities, and the adverse impact on corporate's ability to continue to provide services to consumer credit unions. In the third presentation, we focused on NCUA's efforts to stabilize the credit union system, to ensure access to adequate liquidity so that lending activity and payment systems processing continued uninterrupted, and to seek a resolution of the crisis that would be a least costly outcome for federally insured credit unions. In this fourth presentation, we will focus on NCUA's action plan to resolve the problems with the corporates, especially in dealing with the so-called legacy assets, that is, the distressed securities which have marred the books of several of the largest corporates. NCUA explored many options for a solution for dealing with these legacy assets. As an essential part of the background for this discussion, it is important to remember that the losses of the corporates and the costs of the system-wide stabilization efforts will ultimately be borne by all federally insured credit unions according to the proportional loss sharing of the Federal Credit Union Act. From the beginning, NCUA has taken action to limit the cost of resolving these problems. This presentation will highlight some of the steps NCUA took to limit the costs to credit unions. NCUA has now initiated a solution for the troubled corporates by isolating and funding the legacy assets. This plan provides for an orderly transition toward a new regulatory framework and toward a stable, safe, and sound future state for the corporate system. A transition period will ensure the system's safety and soundness, while enabling credit unions to decide how and from whom to receive the vital services that the corporates currently provide. NCUA has set a comprehensive solution into motion. This presentation will provide a full explanation of this plan. In developing this resolution plan, NCUA was mindful of three important priorities to consumer credit unions. Rest assured your insured deposits are safe. They are backed by the full faith and credit of the United States government. Credit unions will not have to move their payment systems processing precipitously, but will need to make some operational decisions in the near future. In addition, NCUA has always worked to contain the costs as much as possible while still making sound public policy decisions. Since the current economic crisis began in 2007 and intensified in 2008, NCUA's goal has been to stabilize the credit union system and to strengthen the confidence of the general public and of consumer credit unions in the corporate system. Maintaining adequate liquidity in corporate credit unions was and remains imperative to the stability of the entire credit union system. NCUA took deliberate and decisive action in implementing a comprehensive plan to put corporate credit unions, and consequently the entire credit union system, on a stronger foundation. The first phase was to stabilize the system to ensure that no disruption of services to consumers would occur. The second phase is to resolve the problems in individual corporates by isolating and funding the distressed securities that have caused systemic risk to the industry. The third and final phase will be to reform the regulatory regime that governs the corporates and to design a transition framework that allows consumer credit unions the choice of payment system providers and liquidity providers. Through their collective decisions, consumer credit unions will determine the ultimate future of corporate credit unions. Over the past 2 years, since the global financial crisis began, the investment losses at the largest corporates became so significant that they threatened the corporates' continued financial survival. Because of the potential impact on consumer credit unions, NCUA had to step in and take action to ensure that the corporates could continue to operate. NCUA injected $1 billion of capital into U.S. Central, secured liquidity, obtained legislative changes to allow for the isolation and funding of the legacy assets over several years, and placed two corporates into conservatorship to ensure that their payment systems, affecting millions of consumers, would not be interrupted. We discussed these actions in previous presentations, and we will quickly recap them now for this discussion. To help you understand why NCUA action was necessary, let's walk through what might have happened if NCUA had not stepped in to stabilize the situation. Had NCUA not intervened and taken unprecedented action to help stabilize the industry in 2009, federally insured credit unions were exposed to $40 billion of potential cascading losses throughout the system. Under the temporary Corporate Credit Union Share Guarantee Program, consumer credit unions were able to maintain their deposits at corporates, and collectively, the industry prevented these devastating losses from occurring. The Share Guarantee Program has provided much-needed stability in the system to prevent NCUA from the need to sell the legacy assets at depressed market values. With the Share Guarantee Program in place, the credit union industry avoided market losses of $30 billion. Now, let's consider the cascading effect on the system that would have occurred if the corporates had been forced to liquidate their legacy assets to meet the liquidity needs of their members. The cascading effect of losses, as shown in this graphic, could have caused the disruption of payment services for tens of millions of consumers. This very real threat required NCUA to move decisively in the ways we just described to stabilize the system and protect the interests of credit union members. What would have happened if the corporates had sold over $50 billion in legacy assets at depressed market prices in 2008? If they had done so, the loss on the legacy assets would have been $30 billion or more. That degree of losses would have overwhelmed the system. The corporate credit union's total retained earnings were approximately $2.4 billion. The first cascading loss would have been losses to the share insurance fund, paid-in capital and membership capital holders, and uninsured shareholders. That would have resulted in an estimated 885 to 1,200 consumer credit union failures. The cost would have equaled $4.7 to $11.7 billion. The second cascading loss would have stemmed from the need to replenish the share insurance fund. At the time, the share insurance fund balance was only $8 billion. The premiums imposed on the surviving credit unions to replenish the share insurance fund would have resulted in as many as 1,300 more consumer credit union failures. The total capital in the credit union system would have been reduced by $40 billion, and as many as 30% of consumer credit unions would have failed. This would have resulted in a severe loss of public confidence in the credit union system. We will now provide a brief discussion of the actions that the NCUA board approved to prevent this. NCUA maintained its focus on two paramount objectives in developing a solution to resolve the current situation. Those objectives are ensuring that no disruptions to the consumer payment systems would occur, and minimizing the cost, to the extent practical, of the resolution plan, since all federally insured credit unions will pay for the resolution. In 2007 and into early 2008, the level of consumer credit union share deposits in corporates remained relatively stable. During that time frame, the first signs of the economic downturn were developing, and credit unions were seeking a safe harbor for their funds. Consumer credit unions saw corporates as one of the safest places to put their money. In February 2008, consumer credit union deposits in corporates were at just under $91 billion. In late 2007 and early 2008, however, the unrealized losses on securities held by the corporates increased significantly. As consumer credit unions became aware of the growing trend, and as unrealized losses mounted, many began to withdraw their funds from the corporates. By December 2008, consumer credit union deposits in corporates had declined to $59 billion, a 35% decline from February. Since corporates could not sell their legacy assets without realizing significant market value losses, in accordance with generally accepted accounting principles, they were increasingly relying on borrowed funds to meet their share withdrawals. As the value of the legacy assets being used as collateral for the borrowings continued to decline, corporates were finding it difficult to fund the withdrawals made by consumer credit unions. To ensure that adequate liquidity remained available to the credit union system, NCUA took a series of unprecedented steps. NCUA's goal was to keep liquidity flowing so that payment system transactions could be funded, demand for consumer lending could be met, and the reliance on outside sources of liquidity could be reduced. During the stabilization phase, the NCUA board approved and adopted a number of programs to improve liquidity within the system. The temporary Corporate Credit Union Share Guarantee Program provided an NCUA-backed guarantee of all shares in the corporates, excluding paid-in capital and membership capital accounts. In addition, the temporary Corporate Credit Union Liquidity Guarantee Program was implemented. The liquidity guarantee provided an NCUA guarantee for new unsecured debt obligations issued by any corporate. As the liquidity crisis occurred, NCUA also used direct resources as well as its authority to serve as a provider of liquidity. NCUA obtained congressional authorization to bring the Central Liquidity Facilities, or CLF, full statutory borrowing up to its limit of $41.5 billion. NCUA developed several programs to use the CLF as a means of easing the demand for liquidity in the credit union system and to inject funds into corporates and consumer credit unions. Congressional approval was also received in 2009 to establish the Temporary Corporate Credit Union Stabilization Fund, or the Stabilization Fund, so federally insured credit unions could repay the costs related to the resolution of the corporate credit union crisis over 7 years or longer if extended with the concurrence of the Secretary of the Treasury. NCUA explored many avenues to resolve the current situation. Later in this presentation, we will discuss the solution implemented by NCUA to address the legacy assets, limit the costs to consumer credit unions, and to protect the 90 million account holders at America's credit unions. The resolution phase of NCUA's strategy involves a comprehensive solution that incorporates sound public policy, proven resolution strategies, and appropriate flexibility. The principles governing the resolution strategy aim to prevent any interruption in services to consumer credit unions and their 90 million members, preserve public confidence in the credit union system, achieve a solution at the lowest long-term cost consistent with sound public policy, facilitate an orderly transition to a new regulatory regime and future state for the corporate credit union system based on consumer credit union choice. One of the key objectives in creating this plan has been to provide a framework for effectively managing the costs to consumer credit unions over a period of time. NCUA has also been working toward fully resolving the solvency, liquidity, and reputation risks associated with the corporate credit union system, with the goal of ending the extraordinary government support programs as soon as possible. The comprehensive plan approved by the NCUA board on September 24th aims to isolate and fund the legacy assets and limit the costs to the credit union system. As we mentioned earlier, any abrupt sale of the distressed legacy assets would threaten the future viability of the entire credit union system. To avoid this, the NCUA board approved a plan to limit the losses so as to protect consumer credit unions from paying for the much larger market losses that might stem from a sale of the corporate's legacy assets. NCUA has approved a permanent solution that will isolate and fund the legacy assets that have been on the books of the troubled corporates. The resolution process involves 3 stages. The core elements of this process have been used successfully by NCUA and other regulatory agencies over the years. This action will also ensure assessments for costs can be made over up to 10 years. The NCUA has consulted with the Treasury, Federal Reserve, and the other federal financial regulators in developing these plans and will continue to work closely with these agencies to ensure the orderly resolution, the effective implementation of these steps outlined, and the continued smooth operation of the credit union system. First, in order to isolate the legacy assets, NCUA has assumed direct control over all corporates that are not financially viable. This necessitated placing 3 additional corporates into conservatorship for a total of 5. 2 of these corporates, U.S. Central and Western Corporate, have already been in conservatorship for more than 18 months. On September 24th, 3 additional corporates that are not financially viable, Constitution, Members United, and Southwest, were also placed into conservatorship. During the conservatorship phase, corporate credit unions will conduct business as usual to meet their members' payment systems needs and will not experience any changes in the way they process transactions for members. As part of the isolation of the legacy assets, a bridge corporate will purchase and assume the good assets and member services of the old corporate. The bridge corporate will continue to operate until its members can make a transition in an orderly fashion to obtain services from a new provider. This step will ensure that services will continue uninterrupted as members consider their options and perform due diligence. Meanwhile, the corporate's bad assets will remain in an asset management estate. This approach also preserves capital holders' legal claims in the event actual losses are significantly less than expected. Capital holders will be issued claim receipts to reflect their legal claims. However, it is very unlikely that losses will be low enough to result in any recovery. NCUA will continue to ease the burden on consumer credit unions and enhance transparency to the affected credit unions. Any costs and losses related to individual corporates will be charged back to the individual asset management estates, so the costs will not be commingled. In the next few slides, we will discuss the next essential part of the resolution process, its funding elements. The next action is what we refer to as the funding stage. The bridge corporate will inherit all shares and certain good assets. NCUA will temporarily owe money to the bridge corporate while it is raising funds through the long-term financing solution for the legacy assets. A simplified balance sheet is shown in the accompanying graphic, illustrating why and how a difference will occur. The temporary corporate credit union share guarantee program remains in effect through December 31, 2012. As such, consumer credit unions are encouraged to take advantage of the share guarantee during the resolution period. It is critical to the success of NCUA's efforts that shares remain in corporates while we complete the resolution process. The legacy assets will be placed into an asset management estate, and a securitization trust will be established. This trust will ensure that the cash flows from the securities will flow correctly into a new securitized guaranteed instrument. We will discuss this further in the next few slides. The long-term financing for the legacy assets will achieve one of the core objectives of limiting losses to the extent possible to just the underlying credit losses in the securities. The long-term financing will come from the securitization of the cash flows from the legacy assets. NCUA will pool the assets' cash flows, will repackage them into marketable securities with a guarantee from NCUA, and will then sell these new securities to investors in the open market. Since the new securities' principal and interest payments will be ultimately backed by the full faith and credit of the U.S. government, the securities will be attractive to a variety of investors. The securities are permissible investments for credit unions. NCUA will soon issue a letter to credit unions that will discuss suitability standards and various factors that a credit union should consider if interested in purchasing this type of security. NCUA has retained Barclays Capital Incorporated, New York, as its advisor for the transaction. Barclays Capital has provided a great deal of analytics and assistance in structuring the specific sales. In particular, NCUA has gone to great lengths to match the cash flows and terms of the new securities to the underlying legacy assets. This was done to mitigate the interest rate and liquidity risks associated with the legacy asset funding. In addition, as the cash flows from the underlying legacy assets are projected to be sufficient to fund the new securities, no NCUA guarantee payments are expected. This is sometimes referred to as over-collateralization. However, in the event the actual bond defaults increase beyond expected levels, NCUA might need to make a guarantee payment. As we explained earlier, the legacy assets declined significantly in value based on depressed market prices. From a credit quality perspective, they are also distressed. As a result, the defaults on these distressed legacy assets are expected to be between $13.9 billion to $16.1 billion. This cost will be borne in the following ways. First, by those entities that contributed capital to the corporate holding these legacy assets. This amount totals $5.6 billion. The losses above $5.6 billion will be borne by all federally insured credit unions through assessments of the stabilization fund over time, currently ranging between $8.3 to $10.5 billion. Credit unions have already paid $1.3 billion in assessments. Thus, the projected range of remaining assessments is $7.0 to $9.2 billion. In the third part of the process, or what we refer to as the transition phase, bridge corporate credit unions have been chartered by the NCUA board to operate and provide uninterrupted services to member consumer credit unions. As previously indicated, each bridge corporate will purchase and assume the good assets from the old corporate. Member services will continue to operate until they can be transitioned in an orderly fashion to a new provider. The newly chartered bridge corporate credit union will assume assets and shares, or member deposits. The overriding principles of this process will be twofold. First, provide continuity of operations, and second, ensure the least cost to credit unions consistent with sound public policy. The bridge corporates will have simple balance sheets, since the majority of the old corporate's former assets will remain with the asset management estate. Bridge corporates will be highly liquid. They will be operated to ensure stability and to minimize disruption to the member settlement activities and operations. No new services will be offered by a bridge corporate except if it needs to enhance the security and functionality of existing services. The bridge corporate will only provide short-term lending to consumer credit unions that are members of that specific bridge corporate. NCUA's Central Liquidity Facility is available to consumer credit unions in qualifying liquidity situations. Bridge corporates will not offer investment products other than short-term certificates. Bridge corporates will remain in conservatorship throughout their existence. The NCUA board will appoint the agent for the conservator, who will serve as the principal point of oversight for operational activities at each bridge corporate. A conservatorship CEO will be appointed and will report directly to the agent. The CEO will be responsible for ensuring compliance with applicable laws, regulations, and regulatory agreements and orders, managing relationships with members and other outside parties, implementing conservator-authorized policies, and holding senior management accountable for the financial health of the bridge corporate. The CEO will operate under written authority outlining his or her duties and responsibilities, principally asserting fiscal and financial diligence and ensuring continuity of services. Continuity of operations will be maintained through the use of existing corporate plans and policies applicable to the business units at each bridge corporate. The bridge corporate will be required to prepare operational, financial, and other reports on its financial condition and operational capacities. It is imperative for consumer credit unions to remember that the existing share guarantee will continue at all corporates, including the bridge corporates. The plans are to have the bridge corporates in existence for a target up to 24 months. This time frame was set for consumer credit unions to be able to transition their services to other vendors or to new corporate to provide services to their membership. Now we will cover some of the various alternative options that NCUA considered in addressing the legacy assets. The NCUA board held numerous town hall meetings to solicit and consider public and industry input into the resolution and overall reform of the corporate credit union system. The NCUA board directed staff to review every available option and look for a least-cost alternative for the credit union system that also met an expectation of sound public policy. The conservatorships at U.S. Central and Western Corporate have been successful to date in that members have continued to receive the critical services they need to provide services to the 90 million members of consumer credit unions. However, maintaining the status quo was not seen as a valid long-term solution for consumer credit unions. Maintaining the status quo would not achieve long-term corporate system reforms or provide a near-term solution to the ongoing risks. Consumer credit unions and other market counterparties to corporates are growing weary of waiting for resolution. Long-term government support of the troubled corporates creates moral hazard, and it is unsound public policy to use federal assistance to prop up failed institutions. Also, ongoing conservatorships do not provide adequate closure for the overall credit union system to move forward. The continuing potential for further losses in the legacy assets, a devastating fire sale of securities in case of future liquidity events, and the likelihood that consumer credit unions may not wish to put further capital at risk makes this option unlikely to achieve any of the governing principles that NCUA continues to adhere to. NCUA often resolves problem institutions through mergers. Among the consumer credit unions, there have been a sufficient number of stronger credit unions, defined in terms of management capability, asset size, asset quality, capital, and earnings, that have had the capacity to absorb weaker institutions. Many times, the mergers are accomplished through cash assistance from NCUA. This type of resolution process is most often the preferred method, as it provides for continuity of services to the merging credit union members. The corporates that do not hold legacy assets do not have the size to absorb the weaker and larger corporates that do hold legacy assets. The largest four corporates represent nearly $66 billion of the $100 billion in assets in the entire corporate system. Another option considered was a straight liquidation of the troubled corporate credit unions, which would have included a share payout under the guarantee program. Liquidation is usually the highest cost alternative. Unrealized losses on the legacy assets would have to be recognized through the outright sale of the securities, resulting in a substantial additional cost. That cost, in turn, would have to be passed on to consumer credit unions. Secondary losses due to stabilization fund assessments would cause additional failures among consumer credit unions. In addition, current government cash resources for NCUA are not sufficient to meet that cash demand without making immediate multiple large assessments of consumer credit unions. The most important factor in not pursuing this option was the potential for disruption of services to the consumer credit union's payment systems and to millions of consumers. Confidence in the credit union system would be lost. In the aggregate, there exists adequate capital in the credit union system to absorb the losses. However, if all the losses were taken at once, it would have very significant consequences for the credit union system, not the least of which would be a loss of the confidence of members. All eligible shares will continue to be guaranteed until December 31, 2012. Consumer credit unions' continued support of the corporate system and your willingness to keep excess shares in corporates continues to be imperative for the success of the industry. The stabilization fund will be used to pay over time the expenses associated with the problems in the corporate system, which will reduce the annual economic impact on all insured credit unions. Managing the stabilization fund and share insurance fund over several years provides time to spread out the costs for insured credit unions. Looking to the future, the decision by consumer credit unions as to whether to use the services of corporates and to provide funds to recapitalize the corporate system will be aided by understanding the new corporate business model based on NCUA's regulatory changes. The actions taken by NCUA to date have focused on stabilizing the corporate credit unions and mitigating the costs. Before corporates and consumer credit unions can move forward, it is necessary to have any revisions to NCUA's corporate rule in place so that there will be a full understanding of the regulatory framework under which corporates will operate in the future. The NCUA board on September 24th approved the new corporate rule so the system can move forward. The main objective of the new corporate rule is to prevent potentially catastrophic losses from ever occurring again. That is why NCUA revised the corporate rule, to create a stronger regulatory framework. NCUA received more than 800 comment letters and many verbal comments during town hall meetings and webinars after proposing the new rule. In addition, the NCUA board hired a third-party investment analysis firm to review and provide additional comments on the proposed regulation. The financial markets are continually evolving, and thus new risks are continually arising. However, if regulations for financial institutions were drafted with the goal of preventing all risk, financial institutions would not be able to operate. Risk, after all, is part of capitalism. Yet there are lessons learned from the current economic crisis that can and must be addressed in shaping sensible regulatory changes for the future. It is imperative that the regulations governing corporates, as much as possible, prevent a similar crisis from occurring again. The final rule will take effect by January 2011. Let's now briefly discuss the substantive changes to the rule. The rule provides new capital standards to ensure that corporates maintain capital levels consistent with the risk associated with their assets and business activities. After a phase-in period, corporates will be required to have at least half of their 4% capital requirement comprised of retained earnings. The rule provides NCUA with new prompt corrective action tools for dealing with undercapitalized corporates. Prompt corrective actions tools currently exist for consumer credit unions, but not for corporates. The rule spells out specific actions that NCUA must take at corporates that do not meet and maintain an adequate level of capital. The rule continues the requirement for the use of credit ratings in evaluating investments. However, the reliance on credit ratings is significantly reduced as a result of some of the other limits that are either introduced or strengthened in the new rule. The revisions include requiring a corporate to review all the ratings from every credit rating agency that rates a particular investment, and requiring a corporate to use the lowest of those ratings rather than selecting a single credit rating agency's assigned rating. The rule reduces the exposure that a corporate can have to one obligor from 50% of capital to 25% of capital. An obligor is defined as the primary party obligated to repay an investment. The rule also introduces new specific concentration limits by investor sector. Separate sectors, for example, are mortgage-backed securities, student loan asset-backed securities, credit card asset-backed securities, and corporate debt obligations. By placing limits on specific sectors, the regulation will limit the losses that a corporate will be exposed to in case a problem develops in any particular sector. The rule adds requirements that will limit the cash flow mismatches between corporate assets and liabilities and shortens the average maturity of their investments. The maturities of assets were capped to ensure a better match with the funding sources. The changes to investments and asset liability management are intended to work together to ensure that the corporate's investment portfolio is safe and liquid while still providing sufficient flexibility to operate profitably and increase the level of retained earnings. The revised corporate rule also addresses credit union service organizations, an entity that is at least partly owned by a corporate that primarily serves credit unions and that restricts services to those related to normal credit union business. Some of the typical services offered include investment advisory, brokerage, payment system processing, and business consulting services. The changes to the corporate rule provide NCUA with greater regulatory oversight. In addition, permissible services are more closely limited to those that directly relate to assisting the operations of consumer credit unions. Any service must receive prior NCUA approval. Another significant change to the corporate rule relates to governance. These changes recognize that corporates exist to serve consumer credit unions, and consumer credit unions are the primary members of the corporates. There needs to be a clear understanding on the part of the consumer credit unions as to the business goals and objectives of the corporates to which they belong. If consumer credit unions are going to be expected to recapitalize the corporate system, consumer credit unions must have an informed voice in corporate operations. There must be transparency with regard to the operations of the corporates. Changes to the corporate rule require the disclosure to consumer credit unions of the compensation for the senior executives of their corporate. Consumer credit unions should be aware of the salaries, benefits, and bonuses being earned by the senior executives of the corporates in which they are investing their capital and on which they are relying for essential services. The rule also sets forth minimum qualifications for individuals to serve on the board of directors of a corporate. Directors must represent member entities, and the majority of the directors must represent consumer credit unions. To qualify to serve as a director of a corporate, an individual must hold either a chief executive officer, manager, chief financial officer, treasurer, or a chief operating officer position. It is imperative that directors have an understanding of the financial and operational issues that confront credit unions. The future of corporate credit unions will be decided by consumer credit unions, which will need to take a look at the corporate credit union business model under the new regulatory framework and determine whether it meets their own business needs. Some consumer credit unions may find that their needs are best met through their continued relationship with a corporate. With this decision, there will be the cost to possibly recapitalize existing corporates. Member credit unions may look at chartering and capitalizing new corporates to obtain the required services that meet their individual credit union needs. Other consumer credit unions may find that it best suits their needs to obtain these services elsewhere. As corporates' member owners, consumer credit unions ultimately have control over their corporate. Through the election process for the board of directors, consumer credit unions establish the business strategy of their corporate. Consumer credit unions must look at their needs and during the time when the bridge corporates are operating, make decisions on whether their corporate provides the services they require at a price they are willing to pay. Corporates are certainly going to need additional capital to be able to operate as viable financial institutions. Consumer credit unions will be able to influence the future of the corporate system by choosing to provide funds to recapitalize an existing corporate, chartering a new corporate, or going elsewhere for their services. Whatever the future of the corporates, NCUA will continue to take action when necessary to ensure the safety and soundness of the credit union system. Communications and transparency are critical for the credit union industry, and the NCUA board takes this process seriously. NCUA is committed to keeping credit unions well informed. Information will be available through a dedicated corporate system resolution section on the NCUA website. A letter to credit unions was issued that further explains the resolution process. Webinars will be held for credit unions so they can hear directly from NCUA officials. In addition, many town hall meetings will be held across the country to promote an open dialogue between the credit union community and NCUA regarding these actions. Additionally, literature, brochures, fact sheets, and further information will be available for credit unions to help them fully understand the resolution process. NCUA's Office of Public and Congressional Affairs will be issuing press releases periodically to keep the public well informed. In addition, NCUA plans to post updates on the resolution process on the NCUA website and will include information on specific actions being taken at each corporate. These steps will ensure transparency. This brings us to the end of the fourth installment in our series. NCUA's goal in producing these presentations has been to provide you information so that you can gain a better understanding of what led to the current problems confronting corporates and how they affect consumer credit unions. We took a look at why corporates were created and at the services that they provide to consumer credit unions. We reviewed the events that led to the problems in the real estate market and the impact on corporates' ability to provide liquidity. We looked at the reasons why the value of the legacy assets owned by several large corporates declined, and at the accounting requirements that forced the recognition of losses and the erosion of capital. We reviewed the actions taken by NCUA to stabilize the corporate system and to ensure that services to members have been able to continue without interruption. We addressed the cost to consumer credit unions and the efforts to reach the least costly solution to the current problems in accordance with public policy. We also reviewed the revisions to the corporate regulations which intend to prevent a similar crisis from occurring in the future. Please remember that credit union shares are fully guaranteed during this resolution process. NCUA remains committed to ensuring that member settlement and transaction processes continue without interruptions. NCUA has developed a plan for an orderly transition for all credit unions. The plan will also spread out the costs to credit unions to limit the financial impact on the credit union system. We hope that these presentations have been helpful to your understanding of the problems that affected the corporates and, in turn, all consumer credit unions. For the past 40 years, corporates have played an important role in helping consumer credit unions provide services to their account holders, whose ranks now number more than 90 million. In the future, consumer credit unions will need to decide whether a relationship with a corporate still offers value. Such a renewed relationship will come at a cost, the cost of recapitalizing some of the corporates. Or consumer credit unions will need to decide whether it is in their own best interest and the interest of their members to forego the cost of recapitalization and instead to seek services elsewhere. This will be a defining moment for the credit union industry. Whichever decision consumer credit unions make with regard to the future viability of the corporates, NCUA is committed to maintaining a regulatory environment that upholds the safety and soundness of the credit union system.